Hello everyone, this is Kevin Zhao, your finance professor at MTSU. We are in the sixth week of the study. In this week, we'll go through two chapters, private company valuation as well as valuing distressed businesses. During this week, we have fewer chapters to cover, but you still have a lot of work to do. Other than go through chapters, looking at those illustrations and practicing questioning the problems, I want to remind you that the last exam is due next week. It's time for you to work really hard on those problem solving. And the second, it's time for you to wrap up your valuation project. And this week, I expect you guys to send me your draft of your valuation project so I can look at it and give you some suggestions. Next week, it's time for you to present your valuation project. Right? And the draft, I mean, you may submit a draft to us so I can look at it, but it's not mandatory. But if you do, I can offer you some suggestions how you can improve your valuation project. Right? So that's what we're gonna do for this week. Let's take a look at chapter 24, private company valuation. So first of all, what is private company? Well, private company by its meaning is a company that is not publicly traded, and in the financial market, there are many so-called private equity firms. Private equity firms actually do transactions for those private companies. Therefore, they do a lot of private company valuation. Unlike venture capital companies, private companies may invest in a matured private company or startup companies. And sometimes they do reverse transaction. They may buy out a publicly traded company and make it a private company. But later on, they will do some repackaging to make that a private company public again in later years. Typically, private equity companies invest in private company, and they will do some reorganization work to improve the performance of the private companies, and then push them for IPO later on. So they tend to buy a private company at a lower price and seek exit after IPO at a higher price. That's what a private equity company do on a daily basis. And previously, we know a person whose name is Mitt Romney. He was U.S. president candidate several years ago. People argue that Mitt Romney is not an average American because his tax rate is too low at 20%. Why his tax rate is 20%? Well, Mitt Romney was a private equity owner. He worked for a company called Bank Capital. Bank Capital was a typical private company. And Mitt Romney's personal income are all from his investment income. Therefore, his tax rate stood at 20%. So that's a private equity firm. In Nashville area, there are many private equity companies, and many MTSU alumni actually work as financial analysts for those companies. It's a very interesting business. So let's take a look at how we evaluate a private company in this chapter. First of all, let's take a look at the process of valuing a private company. And valuing a private company is very similar to the process of valuing a public company. First of all, you estimate its future cash flows, and then you estimate a discount rate based on the riskiness of the cash flows, and then you compute the present value, which is the estimated price for a private business. And you can do evaluation on the entire business by discounting cash flow to the firm at the cost of capital, or you can evaluating the equity part of the business by discounting cash flow to equity at the cost of equity. So regarding the method, it's very similar to those we use for valuing a public company. However, when we do private company valuation, there are two very common problems that you need to deal with. First one is there is no market value for either debt or equity in a given private company. So how do you calculate weighted average cost of capital? You need a weight, but here it's hard for you to get number of market value on either debt or equity. That's one problem. And the second problem associated with the financial data, the financial statements for private companies are likely to go back just a fewer years, and those statements typically has less details and have more holes in them, so it's hard for you to get a accurate estimation on many financial metrics. So that's two standard problems that analysts are facing when they evaluating private companies. So first of all, regarding the market value, I mean, private company is not publicly traded, and you cannot get any number for value for equity or debt, but you do need market values as input in the valuation model. And here, that ratio for going from unlevered to levered beta and for computing cost of capital, that's one issue that you need to think about. And the second one is the market price to compute the value of option warranty granted to employees. And so this is the second problem that you need to address a little bit later. And the market value is also an output when you evaluating this company, when valuing publicly traded company, the market value operates as a measure of reasonableness, but in private company, the value stands alone. And lastly, the market price based risk measures such as the beta, bond rating are not available for private company. For cash flow estimation, there are four typical issues that you need to address. First one is the shorter history. Private company often have been around for much shorter time periods than a publicly traded company. Therefore, there's less information available to assist your analysis. And the second, accounting standards can be different. For public company, their accounting their financial reporting has to be consistent with generalized accepted accounting principle, but for private company, they don't have to. Therefore, you might need to do a lot financial statement adjustment to come up with a more reasonable estimation on those accounting items. And the third issue is you will see a lot of intermingling of personal and business expenses. In case of private companies, some personal expenses may be reported as business expenses. And then lastly, for private company, you probably needed to separating salaries from dividends. Because it's difficult to tell whether owners of the company take money from the company in terms of salary or dividends. So that's another issue that you need to think about. And for private company valuation, it will be very interesting for you to come up with several different valuations, and all of them are reasonable. However, those valuations are very different. It could be as large as $5 million or less than $500,000. All depends on the motives of the valuation. Regarding the motives of valuation, you can value private company first of all to show valuation, and this is very typical during a process of divorce or heritage through by calculating estate taxes. So that's the first scenario that you may need to value a private company. And the second one is based on transaction. The motives of valuation is based on transaction, and there are three basic types of transactions. First one is to sell a private company to another individual or private entity, and the second scenario is to sell one partner's interest in the same private company to another partner. That's another type of transaction. And the third one is to sell the private company to a public traded companies. And the last scenario would be to prepare to set IPO price if a private company is going public through initial public offering. Other than evaluating the entire private company, you may choose to evaluate a division or division of a publicly traded company, just like a private company, as preparation to do the spin-off or for sale to another party, or do a sum of the parts valuation to determine whether a firm will be worth more or less if it's independently operated. So motives of valuation really matters, and different transaction will lead to different valuations. So regarding private equity valuation, we have four basic scenarios regarding different types of transactions. First one is private to private transactions. In this case, you evaluate a private company for sale to one individual or one individual to another. And the second type of transaction is private to public, and you evaluate a company for a transaction where a private company is going to be sold to a publicly traded company. And the third scenario is a private company going public. They are going to do initial public offering, and you do valuation for this potential IPO project. And the last one is private to VC to public. Two steps here. First of all, private company will be sold to venture capital company, and the venture company will do something to push this company towards IPO. And those are four basic scenarios for private company valuation, and I want you to know that since scenarios are different, valuation can be very different, and you may be wondering why. I will show you why a bit later. For private to private businesses, here are three key issues that we need to think about. First of all is the diversification. And if it's a private to private company, it's likely that neither the buyer nor the sellers are diversified. Therefore, the risk and return model that focused on market risk could be biased. Model for you to utilize to estimate the riskiness of the company, because if buyer or seller are not diversified, then the risk they will be taking would include not only systematic risk but also unsystematic risk. So the key issue here is discount rate, and considering both buyer and the sellers are not diversified, therefore the discount rate should be higher. And the second issue is liquidity of the investments, and the private company are not publicly traded, therefore it's illiquid assets. For illiquid assets, buyers requires higher return, which will lead to lower valuation on the private company because there's a illiquidity and that is called a illiquidity discount. Illiquidity discount to a private business valuation. And the third issue is key person value. There may be a significant person that is critical to the valuation of the project, such as the founder of the company, CEO of the company, and in this case, when private company is sold to another person or another businesses, it's very likely that the key person will leave the company. And if this person is plays a very significant role in this company's operation, then you will see in the future the revenue and operating profits of business will change drastically because of the departure of that key person. So in your valuation, you probably want to consider this important factor. Now let's take a look at a very typical example. Valuing a French restaurant. Let's assume that you've been asked to value a upscale French restaurant for sale by owner, and the owner of the restaurant is also the chef of the restaurant. And both the restaurant and the chef are well regarded, and the business has been really good during the last 3 years. You have 3-year income statement of the company, although you don't have information about cash flow of or the balance sheet because the restaurant don't do that kind of accounting work. They only report income statement for tax purposes. And a potential buyer is a former investment banker who tired of his life on Wall Street and has decided to cash out all his saving and use the entire amount to invest in this restaurant. So in this case, you see that both buyer and sellers are not diversified. See, they put a majority of their personal wealth into these restaurant businesses. Therefore, they are not only facing systematic risk, but also unsystematic risk. So keeping this in mind when you need to estimate the cost of equity and the estimation of beta. Now you have access to financial statements for the last year, and in the most recent year, the restaurant reported $1.2 million dollars in revenue and $400,000 in pre-tax operating profit. While the firm has no conventional debt outstanding, it has a lease commitment of $120,000 each year for the next 4 years. So this restaurant actually rent a place for the operation, and the annual rent is $120,000. So those are basic accounting information that you get before you do serious valuation work on this restaurant. So based on the information that you see here, okay, 1.2 million US dollar revenue, $400,000 profit before tax profit. If you apply, let's say, 40% tax rate, then the profit would be $240,000. That would be the net income, $240,000, which is about $250,000 US dollars. So for this business, if you were about to buy it, how much would you like to offer? How much would you like to offer? Think about the net income, something around $250,000 US dollars, right? And let's say, hey, you wanted to get a very intuitive estimation on the value of this restaurant by using PE ratio. Let's say on the stock market, average P ratio is about 18, 19, and you think if you could buy a business at a P ratio of 10, that would be a good deal, right? 10 P ratio times $250,000 US dollar net income, that will give you $2.5 million US dollar, $2.5 million US dollar valuation on this private equity or this French restaurant. So would you like to spend $2.5 million US dollars to buy this business? You say, it's a good deal, right? And if you can get a cheaper price, let's say $2 million US dollars, then you would feel very happy. But here, I want you to know that if you pay $2 million US for this restaurant, it's very likely that you won't be a successful private equity investor. And now I will show you why. Because the valuation would be much lower than what you think, which is about $2 million US dollar. Because when you do this $2 million US dollar valuation, although P ratio tend to be a pretty attractive, which is at 8, but you ignore a lot of issues associated with this private equity valuation. First of all, what about the discount rate? You probably underestimate the discount rate. And second, what about the key person issue? What if this chef leaves the restaurant and your revenue will decline, net income will decline? Have you even think about that? And when you look at that $400,000 pre-tax operating profit, you really need to make sure the chef's salary is included I mean, previously this chef may not pay himself because he's the owner of the restaurant, right? I mean, sometimes there's a mix of salary and the dividend, and the accounting number here may need to be adjusted. That's another issue, right? And also, this is illiquid business. Illiquid business need to be discounted. So yeah, there are many issues that you need to think about before you pay $2 million or even $2.5 million for this business. Now let's take a look at the income statement for this French restaurant. 3 years ago, revenue was $800,000, and right now it increased to $1.2 million. And you see pretty healthy growth in this restaurant. And the second, this company rent the places, and the annual rent is $120,000, and it was treated as operating lease expense. And this lease will continue for the next 12 years. And the salary was $200,000 last year, which include include the salaries for employees in this restaurants. But the chef and owner of the company does not draw salaries from the company. Material cost was $300,000 last year, which is about 25% of the revenue. This is very typical for upscale French restaurant. And if it's a buffet, it could be as low as 10 to 15%. But for upscale restaurant, that's very typical for you to have 20% of revenue spent on materials. Those are food materials. And other operating expenses, including utilities, the depreciation on cooking equipment, so on and so forth, was $180,000, which is about 15% of revenue. And that will lead to operating income $400,000, and after 40% of taxes, the net income is $240,000. And the net income was $204,000 2 years ago, and 108 3 years ago. So you see a short history of operating performance in this French restaurant. It's pretty healthy, and pretty profitable as well. Now, let's do the valuation on this French restaurant. And before you do any estimation on cash flow, we needed to do parameter work trying to estimate the discount rate. Right? You need to come up with a reasonable discount rate. And previously, when we evaluate a public company, we use CAPM model to estimate the cost of equity, and then we search for the value of equity, value of debt, the cost of debt, and the tax rate in order to come up with weighted average cost of capital. But in this case, if you use CAPM model, then you may underestimate the beta or total risk that owners or buyers are going to bear. So because both buyer and sellers are not diversified, and it's not appropriate to use beta as a measure of the riskiness of the company. So you need to do a little adjustment based on this diversification issue. So there's no market price. I mean, you cannot do regression to get a beta, right? But we can use the bottom-up approach to see what is comparable beta for upscale restaurants tradable on the markets. So here you look at a benchmark. And benchmark could be publicly traded restaurants in the U.S. and you look at about 75 publicly traded restaurants in the U.S. and you find that average unlevered beta is 0.86. However, those publicly traded restaurants may not be a good benchmark because some of those restaurants are fast food chains such as McDonald's, Burger King's, or mass restaurant like Applebee or TGI Friday. But the restaurant that you're going to evaluate is high-end French restaurants. So another benchmark that you could look at is high-end specialty retailers because high-end specialty retailers having similar customer that this French restaurants is having. So that's another benchmark you need to consider. So unlevered beta for 45 high-end retailer is 1.18. So it's very likely that the beta of French restaurant is something between 0.86 and 1.18. So this picture showed you the impact of diversification on the riskiness that both buyer and sellers are carrying in this French restaurant. Right? And if investors are diversified, who invested in many different assets, so unsystematic risk can be cancel off each other, be diversified away. But in this case, both buyer and seller don't have any other investments because majority of the wealth are invested in this French restaurant. They are basically all in. Therefore, the riskiness that you see in this case includes not only market risk or systematic risk, but also unsystematic risk. And here, for example, you see 80 units of firm-specific risk compared to 20 units of market risk. Previously, if it's a publicly traded company, you only consider this market risk. But in this case, your risk will increase drastically because buyer and sellers are not diversified, and you do need to include a firm-specific risk into your consideration. So in this case, when you estimate a discount rate by using CAPM model, in CAPM model, beta is the measure of the market risk. But in this private valuation case, you need to develop another measure of riskiness, which is called a total beta. This total beta incorporates both systematic risk and unsystematic risk because both buyers and sellers are not diversified. So now let's take a look at a total beta. To get from market beta to total beta, we need a measure of how much risk in the firm comes from market and how much is firm specific. We can look at a regression of publicly traded companies and the average R squares. Our average R squares across the high-end retailer regression is 25%, which means 25% of the variation in stock return can be explained by market risk. However, it only explains 25%. What about 75%? So 75% of the risk is from is firm-specific risk. It's firm-specific risk. So here is the equation that you can utilize to calculate total unlevered beta. Total unlevered beta equals market beta divided by correlation with the market, and the correlation with the market equals square root of the R square for the market regression. When you look at the benchmark companies, benchmark companies are high-end retailers, and there are 45 high-end retailer companies that you're looking at, and their market beta is 1.18. And R squared is 25%. Therefore, the total unlevered beta equals 1.18 divided by the square root of 25%, which will lead to 2.36 total unlevered beta. Right? And then you look at the leverage of the company to calculate levered beta for this French restaurant. Assuming that this French restaurant is very similar to an average upscale retailers regarding its riskiness. And for publicly traded companies, we can re-level the beta using the market debt to equity ratio for the company. But with a private company, this is not feasible. However, we do have two alternatives. We can assume that debt to equity ratio for the company is similar to average market debt to equity ratio for publicly traded companies in the sector. So once again, we can use the debt to equity ratio from the benchmark group of comparable companies. Or you can use the estimated value of debt and equity as weights in computation. But there will be some technical problem for you to deal with. So here we assume that this private owned company will have a debt to equity ratio of 14.33%, which is similar to average publicly traded restaurants. So if this is the case, then we can calculate levered beta based on levered beta. On levered beta 2.36, and the levered beta would be 2.56 when you apply this debt to equity ratio of 14.33%. You may say, hey, right now this restaurant has no debt. How do you utilize this debt to equity ratio of 14.33%? Well, when you do evaluation, you look at what will happen in the future, right? And in the future, we expect that this French restaurant will have a similar capital structure as a typical benchmark company or comparable company on the market. Once you have this levered beta, it's time for you to estimate cost of equity. Given risk-free rate of 4.25% and the 4% equity market risk premium, your cost of equity would be 14.5%. 14.5%. And this cost of equity is higher than a typical public company's number because here your total beta is pretty high, 2.56. And this total beta incorporates not only market risk but also firm specific risk because both buyers and sellers are not diversified. This will generate a huge impact on your valuation because you have a higher cost of equity due to higher risk, which is reflecting this total beta. Now let's take a look at how we estimate the cost of debt and the cost of capital. And this company doesn't have debt, but in the future we expect the company will finance its capital through debt financing, right? But it hasn't happened yet. It doesn't have bond. It doesn't even have debt. It doesn't have bond. It doesn't have bond existing on the market. Therefore, how do you estimate the cost of debt? Because you need bond price to estimate cost of debt. Or credit rating. This small company doesn't even have credit rating services. So the method that we can utilize is so-called the bond rating, synthetic bond rating approach. We look at the financial ratio of the company to see what is comparable credit rating, and from there we figure out the cost of debt based on default spread for certain credit rating. And coverage ratio, which is very typical for you to estimate its bond rating, equals 3.33, which is the ratio of operating income and interest or lease expenses. And here, the lease expenses is $120,000. So coverage ratio 3.33. By the way, when you have this lease agreement, it's not reflecting income statement. Actually, it is. It's treated as leasing expense. However, when we do evaluation, we needed to do lease program capitalization adjustment, which where we treat this lease commitment as a long-term asset and a long-term liability, and also we will recalculate the expense from this leasing program. And the rating based on the coverage ratio is similar to a typical BB plus. BB plus rated bond with default spread of 3.25%. And here once again we use synthetic bond rating approach, trying to estimate cost of debt. So the after-tax cost of debt equals risk-free rate plus default spread and times 1 minus tax rate. And here risk-free rate 4.25%, default spread 3.25%. Multiply this with 1 minus tax rate will give you 4.5% after-tax cost of debt. Once you have cost of capital, cost of debt, and a comparable debt to equity ratio, which is industry average, then you can calculate cost of weighted average cost of capital, which is about 13.25%. Okay, after we estimated cost of equity, cost of capital, it's time for us to do a little work on the financial statements. And here we have several typical issues to deal with. First one is the lease program, and the second is key person's salary and wage. So yeah, then let's take a look at the stated income statement. The revenue was $1.2 million, and assume that this revenue will remain the same even after the repurchases, and operating lease expense will be adjusted a bit later. And for the wage, previously $200,000, but in the future, once this business is sold, the restaurant need to hire a new chef, and the new chef salary would be $150,000 a year. Materials stay the same. Other operating expenses are assumed to be the same, but here your operating lease is no longer 120. It will treat it as zero because you capitalize this lease commitment, treat it as a long-term debt and long-term asset. And the true cost on this lease program is 69.62. It's not 120. 120 actually overestimated the cost. And this 69.62 is 77.5% of 928. What is 928? 928 is the value of this lease commitment, or the value of this long-term debt, which is the present value of $120,000 for the next 12 years, using 7.5% of discount rate. And the interest expense on this lease commitment would be the true cost on this lease program. So that will lead to lower taxable income, going from $400,000 down to $300,000. And after 40% taxes, the net income would be something around $180,000. So after some critical adjustment, you see that net income number declined significantly from something around $250,000 down to less than down to $180,000. By the way, for this lease commitment, this is how we do an adjustment. You look at $120,000, not $120 million, $120,000 for 12 years, and you simply discount $120,000 each every year by using 7.5% as discount rate to get the present value. And this present value is the value of the debt of this lease commitment, as well as the asset value of this leasing assets. And you do 7.5% times 928 to get annual interest expense on this debt, or this assets. So that's an adjustment on the financial statements, to show you that in the future your real net income would be something around $180,000. And the step 3 is to access the impact of key person effect. And we already did a little adjustment on this key person. We added salary back into our consideration. And also we should look at the impact of departure of this key person on the restaurant's operating income. And then we assume that there will be 20% discount because 20% of customers may no longer interested in this restaurant because the chef has gone. So that could be the case. Therefore, we need to be conservative estimating the operating income adjusted for chef's departure. And let's apply 20% discount. Then the adjusted operating income will go from 370 to 296. I mean, previously operating income was 370, right? And right now, after 20% discount, it will go down to $296,000. And once again, this will reduce the net income in years to come. And step 4, you look at growth rate estimation as well as the reinvestment rates. To complete the valuation, you need to assume an expected growth rate. As with any other businesses, assumption about growth rate has to be consistent with the reinvestment. So reinvestment rate once again equals expected growth divided by return on capital. And in this case, we can assume 2% growth rate in perpetuity and 20% return on capital. And they will lead to 10% reinvestment rate. Right? So even if restaurant does not grow in size, but this investment is critical for you to maintain a 2% constant growth in the longer term. So next step 5 is to complete valuation to calculate free cash flow to the firm. We start with adjust the EBIT to $96,000. Then we apply 40% tax rate, and we will discount free cash flow to the firm by using cost of capital, which is 13.25%. And also we assume 2% constant growth rate and 10% reinvestment rate. So the value of the restaurant equals expected EBIT next year, $296,000, times 1 plus the growth rate, times 1 minus tax rate, that's after tax EBIT, and times 1 minus reinvestment rate. That will give you free cash flow to the firm. Then you divide by the difference between cost of capital and the growth rate to come up with $1.45 million valuation of the company. This is a valuation of the firm. And the valuation of the equity in this company should exclude $0.928 million worth of long-term debt. And this long-term debt is the present value of the lease commitment. And here, the equity value of this restaurant, based on all the considerations that we demonstrate in the previous slides, is $0.5 million, a little over $0.5 million. Previously, you thought this restaurant may worth well above $2 million. But right now, after all the adjustments, considering the impact of diversification on cost of equity, total beta, right? After key persons effect consideration, 20% discount, as well as adding back owner's salary, right? What else did we do? Well, those are basically that we did. Of course, we do capitalization of this lease commitment. And when all those considerations are included, the valuation of this French restaurant declined to $500,000. And this is a private to private transaction. And this is not the end of the story, because as an investment banker talked to this restaurant owner to reach a deal, the investment banker can also mention illiquidity discount. Illiquidity discount for a private company is between 20 to 30%, but it could vary. From one company to another company. And this illiquidity discount 20-30% is pretty reasonable number for buyers and sellers to consider, because this illiquidity discount based on financial research, it could be as high as 35% for publicly traded company. Or there are several studies showing that this illiquidity discount is pretty significant based on Moroni's study. The number is about 35%. Based on Maher's study, that's about 35.4%. And for Sierber's research, the discount is about 34%. So several financial studies showing that illiquidity premium is something around 35%. And in this French restaurant transaction case, you could say, hey, at least like a 20% or 30% discount would be reasonable. So your previous valuation is $500,000. Now you take 30% discount. What's the value of this French restaurant? $350,000. $350,000, right? So that's why I say if you are ready to pay $2 million to buy this French restaurant, you won't be a successful private equity investor. If you are getting, truly as a private equity company, if you're getting this French restaurant around $350,000, but not more than $500,000, well, that could be a very successful transaction for private equity company. And for the seller, for the owner, if owner is getting something close to $500,000 or a little higher than $500,000, I would say that would be a pretty fair transaction. So once again, here are more examples on illiquidity discount based on different studies and different approach. Previously, we thought the number would be 35%, but the most recent research showing that the estimated discount would be something between 20 to 30%. Right? Bludigan study showing that the estimated discount about 25%. And the refined Bludigan approach showing that the illiquidity discount is about 28.75%. And also bid-ask spread approach showing that the illiquidity discount could be as low as 13%. In a real private equity business valuation, I would say illiquidity discount could range from 15% to 30%. That's a pretty reasonable range for you to make estimation of liquidity discount. So that's process that we use to evaluate this private company if it's private to private transaction. What if a public company, let's say a high-end upscale restaurant group, is going to purchase this local private French restaurant and incorporate this restaurant into their public company's operation? And if this is the case, then your valuation would be different. So what would be different? First of all, the buyer is well diversified. The buyer is well diversified, although seller is not. But buyers are willing to pay higher price because the cost of equity, cost of capital will be lower for this public company, and that's one factor to consider. And second, the cash flow may also be affected by the fact that tax rates for publicly traded company can be different from those of private companies. And private company pay 40% tax rate, but for publicly traded company, their effective tax rate could be lower than 30%, lower than 20%, even lower than 10%. That's another issue we can consider. And finally, what about the illiquidity discount? If it's a private company, then there will be no illiquidity discount. So from owner's perspective, if the owner can sell this to a publicly traded company, it's very likely that the owner can get a higher price. So let's take a look at a key difference between two different types of transactions: private to private versus private to public. First of all, the unlevered beta will be different. For private business, that's 2.36, but if it's sold to a public company, the unlevered beta will decline to 1.18. And the debt to equity ratio will be similar. Once again, there will be benchmark industry average 14.50%, assuming tax rate is the same. Right? Although tax rate could be lower for publicly traded company, and the cost of debt about the same, 7.5%. And the levered beta would be, of course, will be lower for publicly traded company. And assuming same, of course, risk-free rate and active risk premium are all the same for all companies. But in this case, if it's private to public transaction, the cost of equity will be substantially lower. Instead of using 14.5% as discount rate, here cost of equity will be much lower, 9.38%. Even with let's say cost of debt is same as the same 4.5%. The cost of equity will be much lower if it's private to public transaction. It will decline from 13.25% to 8.76%. A nearly 5% drop on this cost of capital, and I can tell you that this drop on cost of capital will improve the value tremendously. And here's the valuation. If it's a private to public transaction, previously you add a liquidity discount of 12.88%, which will lead to $453,000 valuation on this restaurant. But if it's a private to public transaction, the valuation stood at 1.48 million US dollars. 1.48 million US dollars. It increased by 3-fold. So now you see, when you do private equity valuation, motives really matters. You really needed to see who is buyer, who is seller. Is buyer diversified or not? Is there any impact on the cash flows and illiquidity, so on and so forth? And the difference is truly tremendous. It's going from a little less than $500,000 to nearly 1.5 million US dollars. So you have two prices, $254,000 versus $1.48 million US dollars. From seller's perspective, it's very likely that the seller can sell this business with a number in the between. But it really depends on who the seller is sold to for this French restaurant. If it's a private party, it's very likely that the price will linger around $450,000. But if it's a public company, then it will go up drastically to nearly 1.5 million US dollars. So it really depends on who is buying these businesses. And the third aspect that we could look at is how to evaluate a private company if it's expected to go through initial public offering. And here I want you to look at the case of Twitter in year 2013, and here you see a big picture for the valuation on this Twitter IPO, pre-IPO valuation, right? And it's not very different from your valuation project. And for your valuation project, I want you to use a similar framework where you set certain tables for you to get parameters, estimating cost of equity, cost of debt. Then you have a table, typically a two-stage model to estimate the cash flows to the firm or cash flow to equity during the high growth time period, and then the constant growth time period. And also you address all those assumptions in your valuation models, the growth rate, the return on capital, reinvestment rate, so on and so forth. Make sure there's a consistency between your growth rate estimation and the cash flows, because when reinvestment rate changes, your cash flow will change as well. And for your parameters, make sure you use reasonable risk-free rate, equity risk premium, tax rate, right? Tax rate. Other than that, your beta estimation, you can use either regression beta or fundamental beta, but fundamental beta would be more useful. But anyway, this showed you a big picture of doing a very typical valuation. But the difference that you will see here is this is for private equity valuation, and this is for Twitter. That's going for public back to year 2013. Year 2013. We want you to go through this illustration in the textbook to see the details of valuation. Right, so that concludes this chapter of valuing private companies. Very interesting chapter, and once again, the details that you need to address are multi-dimensional, and the more factor that you can consider, the more accurate that your estimation will be. But essentially, the private equity valuation varies really depending upon the type of transactions, and different type of transactions will lead to different considerations in your valuation. So that's chapter 24, valuing private equity firms. And the next chapter is valuing distressed firms. It's even more interesting because we're going to use option pricing method to price an equity. I hope you enjoyed this video. I'm Kevin Zhang. I'm always here to helping you to achieve your academic success in this class. And I hope you enjoyed this video. And I will see you in the next chapter.